Welcome to Morningstar. Today I talk to equity analyst Tancrede Fulop about his report about the European utilities sector. Welcome Tancrede. Your analysis is a very thorough overview of the European utilities sector, and you mention some key elements for the future growth in the sector. Can you tell us a bit more about that?
Yes, sure. So we analyze the investment strategy of European utilities, and especially with a focus on renewables. So interestingly, European utilities deleveraged in the past years, so they have some financial headroom that they will dedicate more to organic growth, unlike in the past when they did like big value destructive acquisitions. And they will dedicate 1/3 of their investments to renewables by 2022. And we show in this report that achieved returns in renewables will be mixed, around 6% returns on investments, which underpinned our view that renewables activity have no moat in general, but still, on the other hand, utilities investing the more in renewables will achieve the highest earning growth.
In your report, you mentioned 4 companies that are your top picks within this utility sector. Can you name them all 4, please?
Yes, sure. So RWE, at the current share price, we think there is a 10% upside. And with dividend, you have a 14% total shareholder return. So upon completion of the asset swap with E.ON, RWE will become the 3rd largest European player and the 2nd largest global offshore wind player. That will fuel very high earning growth through 2023 for RWE, and that will also rebalance the earnings towards renewables, which will weigh 65% of the EBITDA in 2023.
Okay, that is number 1. What is the second company that is your top pick?
ENGIE, a bit less upside, 5% as a current share price, but with a high dividend, close to 6%, so dividend yield of 6%. So this you have a total shareholder return of 11%. In line with RWE, I forgot to mention, ENGIE will achieve very decent returns on renewables investments of around 8%, which is well above the average of 6%. And key to that is that ENGIE will apply has an asset light strategy in general. And when it comes to renewables, this asset light strategy translates into the fact that they have a DBSO model, develop, build, sell and operate. So they develop and build the renewable project, and then they sell a stake of it, typically to a financial investors with lower cost of capital, and then with lower return targets, which will be willing to pay a premium to get a stake in the renewable project. So that enables ENGIE to boost returns and to crystallize value upfront.
Okay, and then the third company, which one is that?
SSE, so you have 13% upside to the current share price with a dividend yield of 7%. So this is total shareholder return of 20%. Interestingly, SSE is a narrow moat company. We ascribe a narrow moat to the stock. So they have UK utility, so there is a bit of regulatory risk in the UK, notably with the nationalisation threat of the Labour Party. But SSE has a very attractive renewable pipeline in the UK with a total of 9 gigawatts, and renewables account for around 30% of the group's EBITDA. Recently, they create a new division to group all their renewables assets called SSE Renewables, and that could mean that ultimately they will spin off this division, which could be value accretive because a pure renewables player are traded with a higher valuation multiples.
And then there is the fourth one that has the characteristic that it's a bit overvalued. Can you explain about that?
Yes, Ørsted, very appealing fundamentals. So this is by far the global leader in offshore wind. They have a very limited leverage, so they are able to fund a huge investment program to tap offshore wind value across the world. Recently, they won auctions for big farms in New Jersey, in the US, and in Taiwan. They have an impressive track record in terms of returns on their offshore wind farms, and we expect that to continue with an average IRR of 8.5% for new investments, new offshore wind farms, and that will drive an annual earnings growth of 21% through 2027. Because the uncertainty is low for Ørsted, you have high visibility. It's also a narrow moat rating. But yeah, as you mentioned, that comes at a price because now the share price after the impressive recent rally are overvalued by around 10%. So we would recommend to investors to benefit from any pullback to get an entry point in Ørsted.
Okay, very clear. Tancrede, thank you very much for your overview of the European utility sector.
You're welcome.